Welcome back to the InvestTalk Sector Spotlight, and today we're going to talk about real estate. Now, Luke, this is a very different environment than '08, which a lot of people use as kind of their proxy for how the housing market's going to react when interest rates rise. And I think the big difference in today's market is the fact that there's not a lot of forced sellers. '08 was all about people handing in their keys, not even being able to afford their mortgage payment that was adjustable. Most people are on fixed mortgages, 3% fixed mortgages, and it allows them to continue to afford their payments. And that's kind of the big difference that I see in today's market is that there's really not really a path forward for there to be forced sellers in the market outside of kind of niches like vacation rentals and things like that. But do we think that there will be a change in those dynamics anytime soon?
That's an excellent point. If you think about it, like you mentioned, in 2008 there were forced sellers, whereas now there's forced holders, right? Because even though the real estate market has changed dramatically from a decade ago, it's also changed dramatically from a year and a half ago, right? If you were telling me that you were going to buy a house a year and a half ago, even though valuations are pretty high, I'd probably still think you were crazy. But looking back, it would have been a great idea. Yeah. You have interest rates at 3% versus interest rates at 7.5%. So I think the question becomes, what is really going to change this dynamic?
Yeah. And, this has been building for a while. It's not just that 3% mortgage that has locked people in. It's also underbuilding. People had PTSD from '08, but also homebuilders had PTSD, meaning they were very careful on building too much inventory and getting into a situation like '08, which for some of them, almost bankrupt them, which is a huge issue that they don't want to deal with again. And so what that caused was underbuilding compared to the amount of population growth, especially when you talk about boomers, and I say not boomers, millennials who were growing up after '08, were very young in '08, and since then have now developed into the adults, right? This is the cohort that's in their late 20s, into their 30s mostly, and that's a big buying demographic. And all those people are still wanting to buy homes, but the home builders haven't built nearly enough of them.
Yeah, no, that's a good point. I mean, there are many different types of shackles, right, on the consumer's hands. In one respect, there's the golden handcuffs of lower rate mortgages. On the other hand, there's student loan debt that's coming due that's going to hurt the purchasing power of the people in the generation that you were just talking about who are looking to be first-time home buyers. I mean, this is something you and I talked about recently, is the percentage of homes you mentioned to me that were fully paid off. What was that percentage?
It was like 40%.
Yeah, 40% of homes are fully paid off. So a lot of people aren't really being affected by the raise in rates. It's more of a supply side issue. So when there's systematic issues in terms of supply chain or building houses or people getting burned, it's more difficult to fix the underlying issue, which is there just are not enough homes for people that want to buy them.
Yeah, and then you have the vacation rentals, which, back in '08, Airbnb, VRBO, that wasn't really a thing. And now that's taken, 1 million plus homes off the market that are kind of their small business hotels, really. And so that's a factor as well. Now, all of this has combined to create an environment where home builders, which is a large part of, you call the real estate sector, the home builders are what most people think about when you think about the real estate sector. And they're doing very, very well. In many cases, their market share has doubled, some places tripled from what it was rates going up, right? Back when we had 3% mortgages. And so they may be selling a little bit less, the amount of homes aren't really changing that are moving hands within the new home market because they're the marginal supplier. And their margins are still very good. They're able to buy down their mortgage from right now, mortgage rates are above 7%. And a lot of them are buying their mortgage rates down to 5% for their buyers. Now it's crimping their margins, but they're still, able to earn pretty good profits. And right now, they're near record profits for a lot of them, which is, just shows you how you can't take the last cycle and apply those same principles to today's cycle, because it's always going to be different. There's always going to be different dynamics. And if you just simply use that last playbook without understanding the dynamics and the fundamentals within the industry, they're going to make mistakes. And I think a lot of people have done that by shorting the housing sector. And it's one of the best sectors so far this year.
Yeah. And this is something we talk about really is surrounding when a lot of people think about purchasing a home or purchasing property as an investment. where they are biased, just like some people are biased by the events of 2008. There are people who are biased towards thinking that because their grandparents were able to buy a house for $50,000 and sell it for $2 million 2 years later, that that's possible for them as well. Mm-hmm. But in reality, what we're seeing is that was something that is unlikely to occur again, mm-hmm. right? So there are other avenues now in which you can invest in property like REITs.
Mm-hmm. Yeah, REITs are another way to access the real estate sector. You get strong diversity, right? You immediately get professional management that's been doing this for a long period of time, and you get income that is taxed at your ordinary income tax rate. That's something that everybody who buys a REIT should know if you buy it in a taxable account. I like them in tax deferred accounts like IRAs because you don't have that tax consequence there. But REITs have their drawbacks. There are some sectors that are doing very well, subsectors of the REIT sector, like in the industrial space, hotels, some retail, depending on what you're talking about.
Don't forget self-storage.
Self-storage has been it's coming back down for sure, but long term, it's one of the most profitable sectors within the REITs, within the REIT space. So, the big drawback with REITs right now, though, is because they are pass-through entities. Mm-hmm. Remember, they don't pay tax at the corporate rate or at the corporate level. They pass through that income to the individual, mm-hmm. but they have to pay out 90% of their income. And what that prevents them from doing is repairing balance sheets. So, if the value of their assets are going down, they probably should be shoring up the balance sheets, paying down debt to try to keep things even. But they can't do that. They can only retain 10% of that. And so that's why REITs are suffering right now, along with the fact they're bond proxies as well. So I think REITs are pretty attractive, but you have to be careful to find ones or avoid ones that have too much debt, that are in sectors that are in decline.
Given where the yield curve is at the end of the third quarter of 2023, would you expect the REIT sector to struggle? I mean, it seems to me as though treasury markets are pricing in a higher terminal rate for a longer period of time than even the Fed is saying. Yeah. So if you expect a REIT to be a bond proxy, if you're you're investing in a REIT because it's yielding you 4.5%, but you can get the same thing from a U.S. Treasury, that's probably not going to be good for REIT performance.
Yeah, so there's multi factors that are hitting the REIT market right now. And so it's not just about it having high debt, but also the bond proxy, the fact that 2 years ago, 4.5% yield sounded pretty good, but now you're lagging the 1 year treasury rate when you're investing at 4.5%. So that's why a lot of those are adjusting lower. Now, the worst part of the REIT market right now is office. Obviously, we all work from home. I know we at KPP, we are hybrid environment, but that means there's less demand for office space, and that continues to be in decline. And I think that is something that is a trend that will not change. Most companies are trying to get people back to the office, but we know that's probably not going to happen.
I wouldn't go back.
Yeah, wouldn't go back. Not 5 days a week driving from LA, right? Yeah.
No, definitely.
Yeah. So, this is a trend that isn't changing, and that means there's structurally less demand for office, and it's impairing a lot of those companies. And while some of them may get bounces here and there, I think long term, many of them are going to go bankrupt and probably consolidate. And so that's an area that you certainly want to avoid.
In a way, would you say that, the common phrase that history doesn't repeat itself, but it often rhymes? Mm-hmm. Do you see similarities in what happened in residential housing markets and commercial housing markets?
Well,
the building of residential real estate and commercial real estate?
Well, I think there's definitely been an overbuilding of office. There will be ways to redeploy some of that office space in other ways. So I think there will be, for example, in New York City, mm-hmm. They're talking about transitioning some of those to actually residential. Yeah. And there are still challenges with that. It's very expensive. Most office buildings aren't really set up kind of structurally to be a residential building, mm-hmm. but there can be places that can be reused in that sense. So, I'm more worried about the REITs that are structured more like financial vehicles than those with the hard assets. Because with inflation, hard assets tend to go up in value, and we are in an inflationary environment. I think the mortgage REITs, which a lot of people are chasing yield 10, 12, 15%, they think they're getting this wonderful yield. But all these are companies or REITs that are borrowing short and lending long. They're basically a mini bank. And with the yield curve inverted, like you said, at the end of the third quarter, this is an environment where if they're borrowing it now 6%, 7%, 8%, whatever it costs them to get that capital, and they're holding on to these legacy assets that are only yielding 4 or 5%, suddenly that's negative. And so what a lot of these REITs are doing now and continue and have been doing for a long time is they're issuing more shares in order to pay out those dividends. But at the end of the day, they're just robbing Peter to pay Paul. And that's why I would avoid the mortgage REIT sector, and not chase those yields in this environment. Well, that was an overview of the real estate sector. We thank you for watching and liking and subscribing to this channel. And we'll see you next time on the next edition of the InvestTalk Sector Spotlight.